Market makers lost an estimated $700 million in a single week during the GameStop squeeze, not because they were evil, but because they were trapped by their own hedging math. That same math runs every single day in every options market. And right now, you are almost certainly on the wrong side of it. Forget the villain narrative. Market makers do not wake up plotting against retail traders. They are forced liquidity providers. Under SEC Rule 15C3-5 and NBBO obligations, they cannot refuse to quote you a price. They must be on both sides of every trade, all day, every day. The CBOE 2023 Market Structure Report confirms that market makers account for approximately 85% of all options liquidity on U.S. exchanges. Without them, you couldn't buy a single contract. The spread you pay, say, 5 cents on a liquid SPY option, that is their entire compensation for taking the other side of your bet. Here is the critical point. The moment they sell you a call option, they are short that call. They now have directional risk they never wanted. Their entire operation depends on eliminating that risk immediately. Stop thinking of market makers as adversaries. Start thinking of them as a predictable machine with rules you can learn. Predictable machines have exploitable patterns. Here is the mechanism. When a market maker sells you a call option with a delta of 0.40, they must immediately buy approximately 40 shares of that stock per contract to neutralize their exposure. This is called delta hedging. Now watch what happens as the stock price rises. That call moves deeper in the money. Delta climbs from 0.40 to 0.60. The market maker must now buy more shares. More buying pushes the price higher. Higher price pushes delta higher. More hedging required. This is the delta hedging feedback loop. It is not manipulation in the legal sense. It is mechanical. It is math. And it is the actual engine behind every gamma squeeze you have ever watched on a chart. The top 5 market makers, Citadel Securities, Virtu Financial, Susquehanna, Jane Street, and IMC, handle over $1 trillion in notional options volume daily. When their hedging algorithms move in the same direction simultaneously, the price impact is seismic. When you see unusual call buying in a stock, ask one question: how much stock do market makers need to buy to hedge that flow? That number tells you the direction of the mechanical pressure. Delta changes. The rate at which it changes is called gamma. And gamma is where retail traders get destroyed, or, if they understand it, where they print money. Gamma is highest for at-the-money options close to expiration. That means a market maker who is short a massive position of at-the-money weekly calls faces explosive delta changes for every dollar the stock moves. They must hedge faster and faster as expiration approaches. This creates the gamma squeeze. In January 2021, retail traders piled into short-dated GameStop calls. Market makers sold those calls and were forced to buy GME.